Ratio analysis. Ratio analysis is a financial ratio or accounting ratio states that the relative magnitude of two selected numerical values taken from an enterprise's financial statements, often used in accounting. There are many standard ratios used to try to evaluate the overall financial condition of a corporation or other organization.
Liquidity. It finance that quick ratio, also known as asset test ratio, is a type of liquidity ratio, which measures the ability of company to use its near cash or quick asset to extinguish or retire its current liabilities immediately. Current ratio. The current ratio is a liquidity ratio that measures whether a firm has enough resources to meet its short-term obligation.
Current asset over current liabilities. The current asset of the company is 13,572,457,297 divided by 13,693,805,423 is equal to 1%.
Interpretation. This indicates that the company is able to meet their short-term obligation. Quick asset test ratio. The quick ratio measures a company's capacity to pay its current liabilities without needing to sell its inventory or obtain additional financing. The quick ratio is considered a more conservative measure than the current ratio, which includes all current assets as coverage for current liabilities.
Current asset minus inventory over current liabilities. The current asset is 13,572,457,297 minus 2,134,467,159 divided by 13,693,805,423 is equal to 0.75.
Interpretation. This indicates that the company has the capacity to pay its current liabilities without needing to sell its inventory or obtain additional financing.
Cash ratio. By adding company total reserve, the cash and near cash, adding that sum by the total current liability, that cash ratio is more than other liquidity ratios become the only consider a company must liquidate the resources. Cash ratio. Cash and cash equivalent current liability 24.21%, 13,693,805,424 equals 1.72. Interpretation. This indicates that a company has the ability to pay off short-term liability with a cash and cash equivalent.
Leverage. Leverage is any kind of financial ratio that indicates the level of debt incurred by a business entity against the several other accounts in its balance sheet, income statement, or cash flow statement.
Efficiency. This measures a company's ability to use its assets to generate income.
In accounting, the inventory turnover is a measure of the number of times inventory is sold or used in a time period, such as a year. It is calculated to see if a business has a excessive inventory in comparison to its sales level.
Debt to equity ratio. This shows how much debt a company has compared to its asset. It is found by dividing a company's total debt by total shareholders' equity. A higher debt to equity ratio means a company may have a harder time recovering its liabilities. Total liabilities over shareholders' equity 16,064,564,079 divided by 17,681,442,768 is 0.91. This indicates that the company is borrowing more capital from the market to fund its operations.